It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Hi, welcome to Search for Ease, a weekly newsletter on bonds and bond investments from INR Bonds. In this week, we cover the 7% effect of bonds. As financial advisors would have told you, or investors with following the bond market and looking at the fixed income portfolios, in the last 2-3 months, there has been a very sharp rise in interest rates, at least in the government bond space. So government bond yields have moved up sharply. Last year they were trading at levels of around 6%. Now it's trading at levels of around 7%, over 7%. And with the rising government bond yields, everything else has gone up. All other yields have gone up, including state development loans, Bharat bond ETF, 10-year yields, corporate bond yields, anywhere over 2 years to 5 years and above. All these have gone up. And many of the bonds, including government bonds, STLs, Bharat bond ETF, and corporate bonds, all are trading at around 7% and above levels. Now, with such high yields in government bonds, investors and advisors, financial advisors, are asking the question: is it better to invest in government bonds and SBIs rather than invest in corporate bonds? And because they are offering the same returns. Now, what is the strategy you must adopt? So, in this newsletter, we will cover the strategy that you need to adopt for at the 7%, where every bond which is got a very good safety, is trading at 7% and above. So this is the right strategy to adopt if you're going to invest in government bonds. So here we'll be taking you through what are all the bonds that are trading at both levels and what you should be looking for when you are invest, if you want to invest with high safety, but yet earn 7% plus because inflation is still at around 7%. So what are the options available to you? So in the government bond, when it comes to government bonds, anything over 7 years is trading at 7% and above. So, and the 10-year GSEC is around 7.15%. 15 and 30-year GSECs are over 7.35%. If you take state development loans or STLs, then these anything over 3% is trading, 3 years maturity is trading at 7% and above. And 10-year SPLs are trading at closer to 7.2%. Then going down to Bharat bond ETF, the 10-year Bharat bond ETF is closer to 7.3%. Again, not so much of a great pickup over the resets also. Coming down to corporate bonds, AAA corporate bonds, PSU bonds of over 5 years plus, mostly over 7 years. They are also trading at 7% plus. And corporate bonds, which are AAA, housing finance companies and others, they are over 3-year and 5-year plus bonds are trading at over 7%. And many of them go all the way to 10% levels. And many other corporate bonds that are even slightly lower, plus the NBFC space and other manufacturing bonds, they're also trading at over 7% levels, but they are of shorter maturity. So these are bonds can be about 3-year maturity, 4-year maturity, etc. Today we had, for example, we had Torrent Power, which is coming out of a 5-year bond at closer to 7.4%, while HDFC was going longer bond, closer to 3+% levels. So these are the levels that one is facing. Yesterday, Cholamandalam was coming out with the issue of 4 and 5-year bonds at over 10%. Now, would investors want to or financial advisors, if they are looking for investment clients, want to invest 3 to 5 year shorter maturity bonds at 7%, or go into the highly liquid and very high safety government securities, but of longer maturity, that is at around the same levels. So the yields are same. One aspect that is pretty much standing out is some of the SBLs, state of it, so 3 years, they are trading at over 7%, but these seem to be um, slightly off the curve in terms of they're offering very attractive yields. So one needs to look out for such kind of trade. On the other hand, if you have corporate bonds which are of 3 to 5 year maturity, when interest rates are rising, then corporate bonds would also, because of shorter maturity, they would have less interest rate because the price lock will be very heavy if interest rate rises. But one must remember that when interest rates rise very sharply and government bond yields rise very sharply, corporate bond yields move up. And if they move up faster than government bond yields, the corporate bonds can actually lose the same amount. So, in a strategy sense, the best way one need to look at it is if an investor is looking at 7% plus, does not mind the maturity, and is willing to hold it, to, then government bonds and state development loans are much better. We even are on it, but it's not offering such a great spread over increase in yield pickup over the GSEC, but it does offer some kind of a capital gains benefit for investors. Seems to be much better than the option of investing in delay bond, even with the 3 to 5 year kind of maturity at around these levels. Because when interest rates do move up, then everything else will move up. Sometimes many corporate bonds will face the same. So if investors do want to have a real yield pickup, then they need to look at something which is lower rated bonds, but good issuers, and with 1 year or maximum 2 years maturity at 7 point at around at over 7%. Which investors they're looking around and getting comfortable. What's do know that they have seen many 2 year papers even issuers. So in that sense, I think the strategy that financial advisors need to adopt for investors or investors themselves who will know how to invest in bonds need to adopt if they are looking for 7% plus terms is that government GSEC seem to be better than Fed bonds. Those levels, the highest safety levels, even if they are of lower maturity, like 3 to 5 years. So this is the takeaway from this particular search for each topic. And do reach out to us through our app or go to our visit our website and respond to us for financial advisors who require more kind of such research, insights into the investment, etc. And also download our app, QuickInvest and our bonds. It can give you a curated list of bonds that is specially designed for investors and financial advisors to provide them the solutions that they require for their fixed income portfolios in a rising interest rate and rising inflation scenario. And if you have not subscribed, do follow us on YouTube, Spotify, Apple Podcast, and others for our podcast series. For search for you, please do subscribe for YouTube channel to get the feeds and search for this. And hit the like button if you have, if you do like this. Search for each. Thank you.